7 dividend stocks to buy right now. Your time is precious, so I'll give you the list right away. The first, SGX. The second, Sheng Siong. The third, Riverstone Holdings. The fourth, ST Engineering. The fifth, CICT, which is Capital Integrated Commercial Trust. The sixth, Mapletree Industrial Trust. And the seventh, Ascott Trust. Not just giving the list to you upfront, I'm also giving all the links to do your own research right in the summary sections below. So as always, if you appreciate the effort, smash the like button. And with that, we'll roll in the intro video. I've selected this list of 7 because they have produced very good recent results. That's why I'm directing some direction for you to consider them for your own portfolio. And as always, nothing over here is investment advice. I share with you my findings and hopefully it helps you become a better investor. Without further ado, let's start with the first name for today, which is SGX. SGX, as you know, is our Singapore exchange, and when you buy any stocks in Singapore, you realize that there are fees paid to SGX. While it appears that SGX has a monopoly in Singapore, do note also, for exchanges, competition is global, correct? The problem with SGX over the last 5-10 years is that it's been losing companies listed on its exchange to competition overseas. Many firms right now want to list in US, and even for ASEAN, many companies are choosing instead Malaysia over Singapore. But change could be round the corner. Government has made it clear that they are looking to revitalize SGX, and maybe some initiatives will bear fruits down the years ahead. But right now, they've produced very good results already with a 9% profit surge from its latest results. Revenues, margins, and profitability all surged up as compared to a year ago. Just in case you didn't know, SGX not just makes money from stocks, it also makes money from derivatives. Any traded financial instruments, you realize that they can gain profits from there. This strong performance has translated into share price surge, as you can see over here. Very seldom, correct, that we see a 50% gain for a Singapore blue chip in just 6 months. That is not bank, of course. It feels like SGX has been incubating around $10 for the longest period, and right now is on a crazy surge up all the way to $14. Will it cross its all-time high? I think let's stay tuned and monitor for it. But if you're an SGX shareholder, you have also been rewarded very well with dividends. Dividends has been steadily climbing since 2010, correct? 27 cents all the way to last year, 34.5 cents. First half, SGX has clocked 18 cents for dividend payouts already. So this could be a further improvement over last year even. At current share price, the dividend yield for SGX is around 2.5%, which is among the lowest of today's list. So let's listen out to the next name, who is Sheng Siong. Let me start by showing you Sheng Siong's recent profit numbers. As of this time of filming, they haven't released their 4th quarter earnings yet, but what we can see is that over the last 9 months, Sheng Siong's profits have slowly inched up. Revenue growth 5% year-on-year compared, net income 12.6% increment year-over-year. That has led to earnings per share increment from 6.66 cents to 7.25 cents over the last 9 months. I think the key reason is that Sheng Siong has continued to grow stores in Singapore. They do have a small presence in China, but they're still not making much profits. And as long as Sheng Siong continues to do well operationally in Singapore, the profitability is very stable. Then the question next is, how has Sheng Siong's share price done most recently? Good news, it has started to inch up after consolidating since COVID period. You know, Sheng Siong was the only stock that was surging up when the market crashed during COVID because everybody still had to buy staples such as toilet paper and rice, and Sheng Siong's business just skyrocketed in that period. That's why you see that surge from $1.20 all the way to $1.80. Buying at the peak back then would not have been a good idea, because when the pandemic is over, you realize that the profits will start to come down and normalize a bit. But right now, you're not buying at all-time high. Sheng Siong has seen a normalization and is starting to grow again. For 2024, it's declared 6.4 cents in dividends per unit, which is an all-time high. Compared 10 years ago, you realize that this is almost double already, correct? So whenever you buy into stocks, whenever you do dividend investing, you want the company you own to grow dividends so that your income is inflation protected. Sheng Siong again is in an industry which is super stable. Recession, pandemic, doesn't matter. So if you own such a stock, you can sleep well at night. Speaking about pandemic, let's move on to the third name for today, who was also a key beneficiary during that period. They are one of the most profitable glove companies listed in Singapore, and they are none other than Riverstone Holdings. Let me show you how much money they made during the pandemic. It's absurd actually. They almost did a 5x in terms of profitability just in that period. If you see the profit graph over here, you think that they have collapsed that the business is not doing well, correct? It looks like profits have collapsed. But that's actually very far from the truth. 2020 and 2021 were extraordinary years. That cannot be repeated because whatever they sell in terms of gloves were just making tons of money. Now we are back at the normal period. So let's compare 2023 and 2024. Take note again, what you see in 2024 is also only for 3 quarters and they've already exceeded 2023. That tells you that they've been growing profits on a very sustainable basis. So how do we compare more accurately? I've done the homework to piece in the old graph to show you what it was like before pandemic all the way until now. You would realize that in 2019, they clocked for 9 months 146 million ringgit only, but right now they've clocked 300 million already. More than double what they did in 2019. If you are a shareholder, you realize that they will be paying you more dividends than before. 2019, it was 7.4 cents. Right now, it's at 12 cents. That translates to around a 5% dividend yield from Riverstone Holdings. Just in case you assume they only make gloves for healthcare business, actually Riverstone is known for its clean room gloves. Clean room gloves are needed in the semicon industry, in the automotive industry, and in aerospace industry. You realize that these are high-tech industries and growing fast, and whenever they need production, you bet that more orders will come to Riverstone's direction. Let's now move on to the fourth company for today, who has seen also very big orders coming its direction recently. This is none other than ST Engineering. ST Engineering actually registered a $4.3 billion contract order for 4th quarter. This is from its urban solutions arm. ST Engineering also has aerospace. It also has a defense arm. So $4.3 billion of orders, is that big or not? Let's compare to what is existing in its books. On the left hand side, you'll see that for the 9 months before, they've won $8.3 billion worth of contracts. But in this quarter alone, they've done $4.3 billion, which is good when you compare the pace of acquisition of contracts. This will feed onto its order books past $30 billion, which means also ST Engineering will likely see good profits moving into the years ahead. Comparing year on year, you realize that revenue has jumped up by 11.8%. Net income has jumped up by 9.6%. I think part of this increment is also due to aerospace side, whereby there's more flights right now than before, and ST Aerospace actually makes a lot of money doing maintenance works for aeroplanes. If the profit continues to grow, I wouldn't be surprised that ST Engineering breaks this $5 psychological mark once and for all. It has been holding back ST Engineering for more than 15 years, as you can see over here. They've been seesawing $4.50, $3, $4.50, $3. And right now, cracking $5, they've made an all-time high. ST Engineering is expected to pay 16 cents in dividends, and that translates roughly to 3.21% in dividend yield. Although it sounds low, do note that ST Engineering is in a very defensive sector, and very likely they can grow to 16 cents in the years ahead. Coming to here, if you have questions, leave in the comment sections. And as always, press the subscribe button because I haven't covered banks, correct, in this whole topic. Banks will be releasing the results very soon, and when I find out anything, I'll share them with you. So do subscribe to get notified when I have something to share in this channel. Thank you very much, and let's move on to the fifth name for today, who is CICT. CICT, CapitaLand Integrated Commercial Trust, is our biggest REIT over here. I've shared many times on the channel, they own prime offices in CBD. They also own prime shopping malls in Singapore. They include Bugis Junction, Plaza Singapura, and most recently, ION. Latest results have incorporated ION into the picture. That's why you would see the retail asset performance has jumped in NPI, which is net property income. The retail side is doing well. However, for the office side, because of repair works and the divestment of 21 Collyer Quay, you realize the office assets have dropped in net property income. I think that's just a small blip, because as long as we see occupancy remaining strong, I think CICT can easily inch up its rent and build more net property income down the years. Let's look at its occupancy rate. You realize it's very healthy across the board. Retail side in particular is close to 100% occupancy. With strong operations, CICT has managed to produce a higher dividend for 2024 than 2023. DPU will be 10.88 cents, which translates to around 5.5% dividend yield right now. And this is an increment from previous year's 10.75 cents. I am a bit surprised why CICT did not raise second half's DPU, even though they have registered very strong distributable income. Hopefully they're just keeping some ammunition to raise 2025's DPU. At current share price, CICT seems to be hovering slightly below the average. And again, at current share price, you're getting 5.5% dividend yield. If you're looking for a higher dividend yield, then let's move on to the sixth name for today, who's Mapletree Industrial Trust. Mapletree Industrial Trust owns data centers. That's very different from retail malls and offices. Data centers are in the new economy space, and their properties are mostly in North America, and right now they have expansion into Japan. With the latest acquisitions and a stabilization of costs, Mapletree Industrial Trust has shown an increment of DPU for the last 2 quarters. If you have been a fan of this channel, I've been highlighting this quite a bit. I think the underlying operations are looking very good, and if you see a track record for Mapletree Industrial Trust, you realize they've been consistently growing this over years. How were the good results achieved? You see that borrowing costs have actually inched downwards, but also you realize that although for 2025 they have no refinancing to do, next year they do have 24% up for refinancing, and management has communicated that some of them are fixed rates, and once they expire, there will be a small inch up likely in borrowing costs again. Hopefully by then, the net property income from its data centers are more than able to compensate for the increment in cost. And the 2 shining segments for Mapletree Industrial Trust are in Data Centers Asia, which is Singapore and Japan, as well as high-tech buildings. I don't know if you drive along PIE or not, there's one over there, that's Long Kallang Avenue. If you want to find out a bit better on them, check out my previous videos on Mapletree Industrial Trust. I've mentioned many times before that it is one of my biggest holdings in my portfolio. My average cost for it is around $2.40. If you're to buy right now, you're buying at 10% cheaper than what I did. Currently, Mapletree Industrial Trust share price is really distressed. I am optimistic that it will turn up for the better soon. Now we've covered 6 names for today, which is SGX, Sheng Siong, Riverstone, ST Engineering, CICT, and Mapletree Industrial Trust. The last name I have for you today is also something I own personally. It is none other than Ascott Trust. Ascott Trust is in the hotel business. They own service apartments and hotels, and their assets are all over the world. They have 5 key segments, which are Australia, Japan, Singapore, UK, and US. You would realize that in this performance summary, each and every segment has increased in revenue per unit, correct? On a year-on-year basis. Japan especially is up 37%. Of course, we have to adjust for yen depreciation, but Japan has been a very popular tourist destination. Ascott Trust has been making moves recently more in the Singapore space. They have recently sold away Citadines Mount Sophia at an exit yield of 3.2%, and they've used that money to reinvest into Live Funan, which they claim to have a yield of 4.7%. 1.5% higher than Citadines Mount Sophia. They're trying to communicate to investors, we sold something on a high and we bought something that we believe is good value to drive up dividends per unit. And there's good news also. Chairman and CEO of Ascott Trust have used their own monies to buy into the company. And take note again, these are big amounts, $500,000 and $1 million. So as always, when insiders are buying, I think it validates that things are looking well operationally, and it's just up to Mr. Market to view it more favorably down the road. NAV for Ascott Trust has inched up from 1.11 to 1.15. Borrowing cost has held stable. You would realize that they've been managing to increase this over the last few years. Yes, COVID was a big hit, but operations are smooth already. In fact, DPU is higher than before. First half, they paid 3.55 cents already, which means cracking 6 cents for the year is not difficult at all. this will translate easily to a 7% dividend yield. And buying right now, you're buying almost at COVID price already. If this isn't good value, I don't know what is. And as always, if you'd like to do your own research, and hopefully it helps you make some profits for this year. Thank you for watching right at the very end. And as always, if you'd like to find more on investing, check out my previous video on how I've invested 500,000 of my own monies and build up a dividend portfolio. I'll sign up from here and see you there. Take care as always. Goodbye.